All right, what's up, everybody? Live here on Facebook here today. My name is Nicholas Framirini. I am the Director of Advocacy for the Broker Action Coalition, also the Vice President of Mortgage Star. Here today with the legendary John Wise of Newfi Wholesale. So today's topic, we're going to be talking a little bit about the impacts on if Fannie and Freddie go private and leave GSC, how they will, how that will impact the non-QM market. So a little background here on Mr. Wise. I know you've been in the industry for a little over 37 years, heavy focus on the non-QM space. I know you had a career with Goldman Sachs and all that. So why don't you tell a little bit just about everyone about how you kind of got into the industry and kind of where you found your niche in the non-QM space?
Oh yeah, no, absolutely. Great to be with you, Nick. I hope it's okay. I'm not going to call you Nicholas. Every time see that, I feel like your mother. Like, so I'm going to call you Nick. I hope that's okay.
No, I appreciate that. If you call me Nicholas Antonio, then I'm gonna be turning off the screen and running
Okay.
home.
All right. Well, it's great to be with you. Great to be with the AIM community. Yeah, I'm a second generation mortgage banker. My dad was in the business his entire life. So I grew up around the dinner table talking about mortgages and real estate and the interesting thing is that we always talk about nobody ever went to college to be a mortgage banker. I actually went to college, and while I was in college, people would ask me, what do you want to do for a living? And I would tell them, I don't know yet, but I definitely don't want to do what my dad does. And here I am 37 years later, living my life in the mortgage business. And my background is mostly wholesale, mostly non-agency. That's been the focus for me. I was in the retail business when we first started. We had a small little company that my father, my brother, and I ran called Oakmont Mortgage back in the day. We sold that. We sold that in the early 2000s. And when
Some
when
good
we
timing
started,
there.
yeah, it was very good timing on our part. We started as a retail company, and then, basically converted ourselves into a wholesale subprime company that ended up selling, like I said, in the early 2000s. So I spent most of my time in the non-agency, non-QM space. So my expertise here is really on the private capital side. I obviously stay connected with what's going on with the agencies and privatization and all this discussion, but really the focus for me is on that private capital side of things. And the other thing too, before we get too far in, these are like a little bit of a caveat. These are just my own personal opinions based on my history in the mortgage business. They do not reflect necessarily the views of Newfi or our parent company Apollo. And the topic today is inherently political, and I take no sides. My only goal is for the expansion of home ownership and stable access to the capital markets. And to be honest, there's people a lot smarter than I am who are still speculating on what's going on and what could potentially happen. So a lot of the conversation today is really just based on what I think might happen in the event that this takes place. So just a little bit of a caveat before we get too far into it.
Yeah, of course, gotta get those quick little legal disclosures out of the way here. But yeah, I mean, look, I think you hit the nail on the head here, and so much of the talk in the industry right now is so speculative, right? Because there is
Sure.
a huge known unknown out there that the administration is looking to do this, looking for opinions from stakeholders, and so I think us as an industry are just trying to do our best to understand how can we best be prepared, and I think that it's a good way for us to kind of kick off here as again the focus on this is really focused on that non-QM space, right? So what would we expect to see regarding pricing spreads between agency and non-QM, or would private capital step in to kind of compress that gap? What are some of those things that we could see if we do see the possibility of the Fannie and Freddie leaving
Yeah.
conservatorship?
Yeah. Yeah. Well, I think the biggest question that people are asking, Nick, is whether or not there's going to be an implicit or direct guarantee from the federal government when this transition happens. If there is some direct support, then I think nothing really changes. I think from a pricing standpoint, you'll see the markets be happy about that. That'll be something that'll be welcome. But the speculation is that there won't be a direct guarantee. Maybe there'll be some sort of indirect guarantee, and that's really where the question comes in, because there's two pieces of this. One, if there's no guarantee, the bond markets are not going to like that, and it will raise the cost of capital for agency loans. You'll see the markets shift there. You won't see private capital really come down. You'll see agency rates go up, and the spread between agency and non-agency has been shrinking over time. If you go back to kind of the beginning of non-QM in 2013, 2014, you're talking about 300 to 400 basis points of spread between agency and non-QM product. But over the last decade, you've seen that spread shrink dramatically. And that's really because of the stability of the non-QM space that we've seen over the last 4 or 5 years. Kind of post-COVID, we've seen a lot of really good things happen in the non-QM market. And so you've seen that spread come down to about 100 basis points and 100 to 150. But, the question really is also surrounding this risk-based pricing. And I think, we're in that environment today. That's nothing new. We've been living with risk-based pricing for a very long time now. So I really don't think you're going to see non-QM rates come down because of this impact. I think we're already pricing for. So if you look today, we offer full doc products that are good credit score, lower LTV, that are in the high fives. Agency rates today are this better than I do, but probably kind of 5 5/8, 5 3/4, somewhere in that kind of range. Mid to high fives.
Mid to high fives, yeah.
Yeah. So I think if you look at the non-agency production, people forget that there's about 15 to 20% of what we do here at Newfi is full doc loans, and those are priced really, really well. That spread to agency is probably closer to probably a quarter to 50 basis points in yield, and so when you get that close, we're pretty much already there from a compression standpoint. So that's really the big question is whether or not there will be some implicit guarantee from the federal government, and if there is, the chances that the agency rates are going to look similar to what they are today, I think would be positive. If you don't get it, the markets, there will be some stress in the market, and you'll see those yields have to rise, because bond investors today are investing in agency loans, and their yield requirements are going to be less because they have that direct guarantee from the federal government. They know that there's a backstop there, and because of that backstop, that they're able to acquire those loans for less. And I think the other thing that's probably important to talk about, at least at this stage of the conversation, is we're talking about non-QM here, but what we're really talking about is private capital, and private capital is essentially anything other than public capital, and private capital, call it institutional money, if you will, is already investing in agency mortgages. So that exists today. So every institutional investor has a different yield requirement. They've got different time horizons. They've got different risk appetites. But there's a lot of institutional money now that invest in mortgage-backed securities, and I don't think that will change. The question is whether or not their yield requirements will go up as part of this transition.
Yeah, I mean, it's definitely a great point you make, with especially just how much more private capital has come into the space. I mean, like you said, the spreads have compressed to like 100 basis points. There's been cases where I've priced out DSCR loans that are priced better for me to go DSCR than for me to take it to Fannie and Freddie, which kind of brings me a little bit about talk a little bit about the credit box. Do you think we're going to see expansion to that? What do you think is going to happen with the credit box? I know we talked a little bit about risk-based pricing, but just elaborate that on a bit more.
Yeah, well, it's another big question. Another big question in this whole conversation. So if they privatize, are they going to shrink the credit box? And a lot of people speculate that one of the ways to shrink the agency, the risk around agency for the public, general public, is to just shrink the credit box. So both agencies were created. There's different ways to read their charters. But a lot of people assume that they were created for owner-occupied primary residence liquidity, and not for second homes and not for investment properties. And I think we've seen Pulte come out a couple times and look to shrink the agency's risk in these categories. Today, it's, if you look at the non-owner and second home portion of the agency business, I think it's running somewhere under 10% of the total production. But that's a big question. There's been a lot of questions about whether or not they'll continue to go down that path, and so I think we're already ready. I mean, you actually mentioned DSCR, but if you just look at non investment property loans in the non-agency space, the reason why you're able to get a better rate on a DSCR loan than you are a full doc agency loan is mostly because of prepayment penalty. So obviously on an agency deal, you don't have it. On the DSCR business, you can buy it out, but it gets more expensive. That yield goes up. My guess is if you compare an agency non-owner with a DSCR with no prepay, your pricing probably be better on an agency transaction.
Yeah,
And
for
so
sure. Yeah.
it's one of the things to be thinking about. But there is a chance. So if you kind of think forward and say, well, let's say they're fully privatized, okay, and maybe there's some implicit guarantee, but they're basically operating on their own without public support. Then you have to start thinking about there are a couple things. One is there a chance that they could look at the performance of non-QM business over the last 5 years and say, well, we kind of like that. Maybe we should expand our credit box. And there's a chance that could happen if they're privatized. They have private people running these companies and making decisions about who to lend to and where to provide liquidity in the marketplace. And so there's a chance that they could open up the credit box. I think that's probably the last thing on everybody's mind. I think most people are assuming that if there's any direction, it's going to be to shrink the credit box. And in either situation, I think the private capital, the non-QM business, if you will, is ready to step in and fill that gap, because that's really what we were created for back in 2013. You have this qualified mortgage box, and the non-QM business was essentially created to fill that non-qualified borrower gap, and we're direct interpretation of that qualified mortgage rule. We've obviously gone well beyond that, but that's essentially what we're responsible for, is trying to create good, responsible mortgages that pay, but are more creative than the publicly traded agency business that we see going on today in the markets. And that's our job, is to try and create and push the credit limits to a place where we feel like it's comfortable. And I think we're probably at about that stage. We've pushed the credit box on the private side, I think, about as far as we can right now, especially when you look at the environment, and the environment around us is definitely shifting. So you're seeing values come down, right? So you're seeing value reduction, not in every market, but in a lot of the markets across the United States. You're seeing value deterioration, and that's a concern, because the big driver of non-QM performance today is really skin in the game. I mean, that's what we've learned. I think over kind of, if you go back into the subprime days, it's we always thought that credit score was the primary driver, and if you have a 720 credit score, then you could get more flexible with your underwriting guidelines, and we found out that wasn't necessarily true. And what we've learned in the last decade is that really skin in the game is one of the primary drivers of performance. And when you have it, you can get more creative with your guidelines and take a little bit more risk. But with the markets trending downward, there's going to be people that are starting to tighten up a little bit. And then the last thing is you got to create loans that pay. I mean, if you don't create loans that pay, and so we have to keep a very close eye on the overall markets, which people are talking about maybe a jobs recession going on here. and we have to keep a very close eye on what's happening there, because so the first place to get impact usually is that self-employed borrower, and we got to keep a very close eye on what's happening there.
No, I think that's a great point too as well, that there's so much in the non-QM space where it's not just the bond market, with how you're looking at things when pricing. It's also, the equity standpoint, which I don't think is talked about enough on agency, where, it's more of that LLPAs, obviously credit's involved, and obviously down payment does weigh in, and you get the, better pricing. But in your term, or to your point, in terms of performance, that's a huge point in being proof in the pudding of that, how you're able to do DSCR, how you're able to do these things that most would say, I can't believe this is happening. And, you especially get the folks who aren't in the industry who are like, oh my God, like, have you heard about this loan where you don't have to have any income? We're going back to 2008, and I hear it like at least once a
Yeah.
week. And I'm like, well, no, it's much
Yeah.
different than those days. Right. You didn't make a point there. I kind of want to circle back to regarding liquidity. I think one of the things that I had a bit of a fear of was, you know, COVID came around and, non-QM dried up right away. If
Yeah.
agency had, been, did not have implicit guarantee, and there wasn't that stopgap there, there was, the market
Right.
would have essentially completely froze. When
Right.
it's a massive part of your GDP, you can't really have that be in place. But do
Yeah.
you guys think that institutional investors are ready to absorb significantly higher volumes of non-agency production if we move towards this movement of privatization?
Yeah, it's a great question, and I think if you go back and look at kind of when Dodd-Frank first came out, part of Dodd-Frank included a DTI threshold of 43%, and that was set to expire. People were worried about, once it expired, whether or not the gap was going to be able to be filled by private capital. Non-QM had really just started. There were a lot of discussions about it, kind of running up into 2018, 2019 timeframe. People were really concerned that if that expired and the agency stopped lending for anything above 43%, whether or not the private capital markets would be able to sustain it. And to be honest with you, I'm kind of glad it got resolved without private capital at the time, because the entire machine of non-QM from 2013 up until COVID, the entire machine was built on an origination to securitization model. That was the only exit strategy for anybody that was originating a non-QM loan. You either were a direct securitizer and you were making those loans, or you were selling the loan to somebody who was going to securitize that product. And in March of 2020, when COVID started and the securitization market went to zero, I mean, nobody was securitizing anything, because nobody knew who was going to live, who was going to die, like what businesses were going to make it. I mean, it was really fascinating to see kind of that market reaction, and it took about 6 to 12 months, for that market to thaw again. And that's why you saw all these non-QM lenders basically go to zero. And so thankfully, that DTI threshold didn't expire. They figured out a way to move a different direction. They gave the GSEs this what's called the GSC patch, and allowed them to continue to lend above 43, and then eventually removed the rule altogether, and now it's more risk-based pricing. But I don't think the private capital space was ready at the time because of what we're talking about. So today, the big change today is that there's a second exit strategy now for non-QM business. And the first one, the original one, the securitization market, is currently operating at a very high level. It is, the credit spreads are super narrow, and that has created a really positive environment for people that are securitizing mortgages. Well, it doesn't matter whether it's agency mortgages or non-QM mortgages. It's a very, very healthy securitization market. But as we have seen, that can change. Spreads can widen. It gets more expensive for non-QM lenders to do it, agency lenders to. So the second strategy that now exists in the mortgage space is there's a lot of insurance money that's come into the space that that has decided, rather than acquiring these mortgages through the securitization, which is what they were doing pre-COVID, all these insurance companies, they all love the health and safety of investing in U.S. real estate through these mortgage securitizations. They like the asset, they just didn't like the risk, and the fact that the securitizations went to zero meant that they went to zero. So they started saying to themselves, well, rather than invest in the securitization, why don't we acquire these directly and put them on balance sheet? And that's essentially what's happened. You have 4 or 5 big insurance companies that have stepped into the space and are now acquiring these assets for balance sheet. That's one of the many reasons why the non-QM business is so healthy today. Is to have that second source of liquidity has reduced originators' fears. It has reduced the fear of mortgage brokers, mortgage bankers. Doesn't matter who you are in the system. You have a lot more confidence today in originating that loan, and that's why you see, you go to any of these big mortgage events, and we just got back from Fuse, and everybody there was selling NAM. Same thing, 100 vendors, and almost all of them are selling non-agency product, and so they have the ability to they have the confidence in originating those loans today because of this exit. So your original question is are they ready to step in? I think so. I think certainly our parent, I wouldn't call it insatiable, but it's very, very high, and they like the asset. They've always liked the asset, and I think other insurance companies are going to be very similar to that.
Yeah, I think you can see the timeline really correlate with your bigger named banks, your Rockets, your UWMs, your your New Reses, your companies that would have laughed if you had said, "Hey, you're going to do non-QM." I mean, they were never, right?
Right.
And so
Right.
that timeline really lines up and kind of pulls a layer back to the everyday originator such as myself, and kind of shows you kind of like the dynamics behind the scenes of why and how these products develop. Which I think is important for everyone to know. I think it makes you better at your business if you're able to understand why and how these mechanisms work. So I think one of the biggest things here, obviously some the brokers listening here, if GSE pricing rises, okay, or those guidelines tighten, or a combination of both, how do you think brokers best can position themselves into quickly pivoting into non-QM production?
Yeah, it's a great question, Nick. And I mean, to some degree, I kind of feel like it's already happened. Uh, if you would have gone to a broker event 4 or 5 years ago and said, "Hey, everybody, who's closed a bank statement loan in the last 12 months?" Maybe you get 20% of the room to raise their hand. You go to that event now, and it's most of the room.
Yeah.
And there's a lot of people, a lot of reasons. I think really good loan officers today are. I mean, I say this all the time. I think it's probably the hardest time to originate loans that maybe ever in the 3 or 4 decades I've been in the business.
I really picked a great time to just make this my career, right? I always say I miss the glory days of the 2000s. I got in 2015, so
Yeah. Well, the good news, Nick, is that the mortgage business cycles, and
yep.
This too will end. And so if you look at that and you say, well, gosh, it's the hardest time ever, it means every borrower you get, every referral source you create is that much more valuable to you. And so when you have somebody walk into your shop and say, "Hey, I want to get a mortgage," you're going to do everything you can. You're going to have every conversation with every wholesaler to try and figure out a solution for that borrower. So loan officers don't have the luxury today of walking away from any borrowers. And so as a result of that, you're having more conversations, and these conversations are really where the non-agency space starts. And so I think for me, the encouragement that I would give to anybody in the system is make sure you have a good relationship with a few wholesalers. You can't just have one. Everybody does things a little bit different. So Newfi certainly feels pretty good about the position that we're in, and we know we're servicing our customer at a very high level. But there's some things that we don't do that others will do. So don't just pick one, pick a couple. And I think the two most important things in that choice is first and foremost, find a good account executive, somebody that knows what they're doing, somebody that is willing to pick up the phone and have these conversations early in the process. And so, you have somebody come in and see you, Nick, and they go, "Hey, here's my tax returns." And you look at it and you go, "Yeah, it's not happening." And so the first thing you do is, okay, well, is there another solution? And so that's when you pick up the phone and have this conversation really early in the process. And so finding a company that you can have that early conversation with to give you some direction. And one of the things that we pride ourselves here on Newfi is, if we can't do it, we tell our account execs all the time, make sure you know what others can do, so that you could say, "Hey, I can't help you on this one. I appreciate the phone call, but we've got other options. I've got a couple other lenders that I think might be able to do it. Here's another AE that you should call." So that's kind of the first thing, is make sure you have somebody that picks up their phone and has good dialogue with you about the transaction that you're trying to get done. The second thing that I think is really important in this environment is, we see companies that are newer companies that are trying to figure out this space, and there's a lot of risk there. So, I don't know, did you live through March of 2020 when the non-QM business went away?
Oh yeah. Yeah, no,
Yeah.
I had deals in the pipeline. They
Yeah.
did not
Yeah.
close.
Yeah.
So yes, I very much lived through that
Yeah.
that environment. So
So you want to pick somebody that you feels like puts you in the best position possible, so that if something happens to the liquidity in the markets, that you have a company that you can count on. And that means somebody that may not necessarily be dependent on the securitization market. And because the securitization market is stable today, but who knows what it will look like a year from now. So you want to make a really good decision there. And then I think the other thing too that we find, and I'm not saying this just because we do it, but you have to partner with somebody that's investing back into the community. And so we're super proud of our relationship with the back, and we appreciate what you're doing, and support you and what's happening there. And as a result of that, we love the relationships that come from these types of things, because we think that if you're an originator and you're investing and associating yourself with the back, you're a step above other originators in the marketplace who don't really care who they're doing business with. They just want to look for the absolute best price that day, and it doesn't really matter whether or not it's Newfi or somebody else. And so look for somebody that's investing back into the communities. We're partners with a lot of the people that are out there, Camp and FAMP and NAM and the back. And so we value those relationships and what you guys do. And so I think that's an important part of this choice. But finding the right lender today is going to be super important, so that when this happens, you won't really have too much of an impact in your business.
no, yeah, I mean, I think you make a really good point too, of like, in terms of the partnership side of things. I mean, me as an LO, prior to you guys being a part of back, like, I truly just hadn't heard of Newfi. Like, I'm in the DC metro area. I do a ton of agency business.
Right.
I think I've done 6 or 7 sub 620 FHA loans in the last year. Like, it's just not a large microorganism of where we live, right? Government employees is, I have
Yep.
tons of those in my back pocket. So, I think it's a great point that you make, though, about just any company in the wholesale community, like partnering with, whether it be back or whether it be NAM, whomever it is that you're getting out there and partnering with. It gives LOs such as myself, like, oh wow, like if this company is a part of this, I'm going to give them a shot, because I know that they care. I know they're probably here for the long run, and they're not just some non-QM lender that popped up a couple of years ago that keeps calling me once a week asking what deals can they price out for me.
Yeah.
So
Yeah. Yeah.
so last question here for the brokers that are on the call would be, I know, again, DSCR and bank statement get the, kind of the 1-2 on the stand there, the pedestal. What's a product that you think is kind of really, really great that you see loan officers underutilizing, that you feel could really boost your one's business?
Yeah, no, it's a great question. I think we've touched on a little bit. You're right. Bank statements and DSCR are probably 70 to 80%, depending on the company. 70 to 80% of the total non-QM production. But there's a couple things that I think I would say. One is that you think about non-agency. The one thing that people kind of exclude from it is jumbo business. So prime jumbo business is one. We've been priced really aggressive on this prime jumbo. It's really a price-driven product. It's an AUS driven underwrite that's priced pretty well. So that's kind of the first thing is people kind of forget about that. I think you've seen a lot of originators shy away from originating prime jumbo just because they don't want to compete with the local banks. And what we have found since we've created some products on our end that are priced aggressive is it's giving them an opportunity to compete for those loans. So don't think that it's not possible. The second thing is people don't, I think, realize this either, but 15 to 20% of Newfi's business is full doc. So we actually close loans for borrowers that are full doc borrowers that just miss prime jumbo or agency guidelines for some reason. Sometimes it's a credit score, sometimes it's a small credit blemish, sometimes it's reserves, sometimes it's time on job. There's all sorts of reasons why full doc business is coming our way. And I think as part of that, just as an example of this is we have a product that allows borrowers who have gone from W-2 to 1099. Matter of fact, I would imagine in the DC area, there are some W-2 borrowers that were W-2'd by the federal government that are now 1099 borrowers that are doing the same thing. And on the agency guidelines, you essentially have to wait 2 years. Once that person goes 1099, they become self-employed, and the agency say you got to be self-employed for 2 years. You can sometimes get it done with 1 year. For Newfi, we actually look if it's the same line of work, your income hasn't changed that much. You can get me a pay stub that verifies they've been paid, or you have a contract that outlines this. And you're in a job that doesn't really require investment on your part in terms of expenses. So we see a lot of attorneys. We see some doctors that make these transitions. Some nurses sometimes will make these transitions. Truck drivers sometimes will make these transitions. If you can get that employer to write a letter that says there's no expenses with this job, we actually can make a loan to that borrower as soon as they can get us a pay stub. As soon as they get us proof that they've made.
I always say anytime I do any of these types of calls, or every time I go to a meeting, if there's one thing I can take away, and it's doing it 10 years, I think I know as much as I know. And then it's like, boom, like I didn't know that was a non-QM product. And I can tell you there's definitely been people that I've turned away that I shouldn't have. And I think just this dialogue back and forth reminds me that, and should remind everybody out there, if especially with the full doc being an option, just be like, hey, like before you deny them, like pick up the phone and call your top 2-3 non-QM folks and see if there's a home for it. And I think that's a really good reminder. So
the one other thing, if you don't mind, that I think is important, that we do see all the time. So everybody's familiar with asset depletion that exists in the agency space, and we have it here at Newfi. So if you've got a borrower that has a bunch of liquid assets, we can always deplete that over a period of time and use that in addition to full doc or bank statement transactions. That's certainly a no-brainer. But the one piece that we actually changed recently is for borrowers that actually have money invested in an IRA or a 401k from a job they've left. So you have to be able to access the money, and that means you got to be at a place. The money has to be from some place that you've left. So it either is converted into IRA or it's still in the 401k, but it's from a company that you've left. We actually will take that asset and deplete it over 36 months. And that is a game changer in terms of getting people into properties and loan amounts that they want to buy at. So oftentimes, you hear all sorts of borrowers. I can't, like my DTI pushed over the top. I can't afford what I want to buy, so I'm going to wait until affordability comes down. Well, this is one way to help them get into that house today. Because we always talk about what's the best time to buy a house in the United States. Assuming you're going to be there for 3 to 5 years, the best time is today. Because if you look over the history of the United States of tracking real estate values, there's only been 2 times in history where if you've owned your property for more than 5 years, you haven't made money. and that's the Great Recession and the Great Depression. And other than that, it's always a good time to buy. So you want to try and get those people into those properties today. And one of the ways to do that is with this we call it IRA distribution. It's not really a distribution. It's basically a depletion of the IRA asset. And you don't have to set up the distribution. You don't have to take a distribution. You don't have to get a letter from somebody. We just look at it and say, if you've got that money in that account, we're going to deplete it. And you don't have to be 59 and a half to do it. So if you are 59 and a half or older, we'll take 100% of that asset and deplete it over 36 months. If you're less than 59 and a half, we take a 10% haircut and then deplete it over 36 months. But it's a great way to provide additional revenue.
Yeah, I mean, 10% is not bad at all. I mean, 10% haircut, I think anyone would take all day. No, I mean, that's another one I didn't know about. Another one where, I've definitely had it over time where they can't set up the IRA with withdrawal yet because they're not at a certain age, or it's been in a non account that you haven't been able to set up a disbursement out of. So no, I mean, again, this is why I asked that question, because I view myself as a very confident loan officer. I do a lot of business, and two things I didn't know on but coming into this call. So
Love it.
cool. Well, last minute here. I know you've kind of went into it already. You've kind of plugged in a couple things product wise on Newfi, but anything you want to share just about Newfi as a whole, or any additional information that we didn't touch on?
Yeah, no, I appreciate the opportunity, Nick. I mean, most of the time when I get these opportunities, I think a lot of our competitors will do a product dump. Honestly, I think I'm more proud of our organization for the service levels that we're providing. We do an net promoter score tracking of every loan that closes. So every time you close a transaction with us, we're going to ask you to do a really short survey on how we did. And this month, I know this just because I just got this email. So through the 29th of October, our NPS score is above 85. And if you don't trust me, I'll tell you what that means. But if don't trust me, just chat GPT it and ask what's 85 NPS score. How does that relate to others in the mortgage business? And what you'll find is it is probably at the highest level that anyone can talk about. So we're super proud of how we are doing business, not just what we do, but how we're doing it. And this kind of goes back to not just the account execs who do a great job at working with the loan officers and partners that we do business with, but it extends to all of the people on the support side of the business. So it doesn't matter whether you're an underwriter or a closer or a funder or doc drawer or anybody in the account managers. All these people are providing a really high level of service to our partners. And from where I sit, there's nothing more important than that, because if you have that, then all you have to do is figure out a way to keep growing. We appreciate it.
Couldn't agree more. I mean, and the experiences I've had with you guys, top notch all the way, great AEs, great underwriters. So I attest to that. Maybe I contribute a little bit to that 85. I hope so, but maybe months previous. But do appreciate all the work you guys do. Appreciate your support of the Broker Action Coalition as well. Encourage anyone that's listening out there that has not been a part of the back. Please join us in our efforts to continue to fight the good fight for advocacy and making change in the industry. So thanks again, John. And I hope you have a good rest of your day here, and a good Halloween tomorrow night.
Yeah. Thanks, Nick. Great to be with you. Appreciate it.
All right. See you, John.